Let's now look at example number 3. Entity A has acquired an item of plant and machinery for rupees 1 lakh on 1st of April 2021. It depreciates this item at 10% per annum on SLM basis. What does this mean? The depreciation is actually going to be equal to rupees 10,000. 1 lakh is the cost of the machine. 10% is the depreciation rate. Assuming a salvage value of 0, the depreciation is going to be 10,000 on a per annum basis. For the year ended 31st of March 2012, it provides a depreciation of 10,000, which we obviously know. Therefore, the carrying amount of this item of plant and machinery on 31st March 2012 is going to be 90,000. How is it 90,000? You have 1 lakh less 10,000 of depreciation, less 10,000 of depreciation, which is equal to 90,000 of carrying amount. All right. The question over here basically required us only to find out the carrying amount, which is a very, very easy question. Obviously, the carrying amount is 90,000. Every year, the carrying amount will keep reducing by 10,000. All right. At the end of year one, it is 90. End of year two, it will be 80. End of year three, 70, and so on. And it will become zero at the end of 10th year. It will become zero by the end of 10th year. All right. So example three was a very easy example. Nothing really for us to do. Let's now look at example number 4. Entity A has acquired an item of plant and machinery for 1 lakh rupees on 1st April 21. It depreciated this item at 10%. So therefore depreciation is 10,000 and the carrying amount is 90,000. All right. The same facts as that of example 3. So carrying amount as at 31st of March 2012 is 90,000. As per tax laws, this item is of plant and machinery has to be depreciated at 30% per annum on a WDV basis. This is being depreciated at 30% per annum on a WDV basis. Let us actually get into the calculation of deferred tax. All right. First step is calculating the carrying amount of plant and machinery, which will be equal to 90,000 at the end of year one. All right. These calculations are for year one. So the carrying amount is 90,000. Second is I am going to calculate the tax base of the plant and machinery. Now, if you recall, the depreciation was basically 30 percentage per annum. Depreciation is 30 percentage per annum, and it is on an amount of 1 lakh rupees. All right, it's on an amount of 1 lakh rupees. So 1 lakh multiplied by 30 percentage. The question mentioned that 30 percentage is on a WDV basis, but for the first year, 30 percentage will still be calculated on the cost itself. For the first year, 30 percentage, although it's on a WDV basis, will be calculated on the cost. That is the depreciation for the first year. So depreciation will be 30,000. My tax base will then be 70,000. My tax base will actually be equal to 70,000. Reason being the cost is 1 lakh. I have recognized the depreciation of 30,000 in my tax books. Therefore, my balance sheet, my tax balance sheet will have an amount of 70,000 rupees. All right. It will have an amount of 70,000 rupees. All right, this amount that I've written is actually the amount of depreciation. This is basically the calculation of depreciation. Tax base will be 1 lakh less 30,000, which is equal to 70,000. All right, on my tax balance sheet, this item of plant and machinery will be carried at 70,000. The third step is calculating the temporary difference. Calculating the temporary difference, this is going to be 20,000 over here. All right, now the nature of this, if you think of it, the 90,000 represents that my future taxable income will actually be equal to 90,000. My future taxable income will be equal to 90,000. All right, using this plant and machinery, I will produce inventory. Those inventory will be sold in the market, and therefore my future taxable income or future sales will be equal to 90,000. All right, those sales will be taxed for me. The sales will be taxed in future. Therefore, the future taxable income is 90,000. Against that 90,000 of future taxable income, I will be allowed a deduction of depreciation of 70,000. 1 lakh was the cost, 30% has been allowed in year one, which means the remaining 70,000 will be allowed in future. The remaining 70,000 will be allowed in future. Therefore, this 20,000 represents the net taxable profit that I will have in future. This 20,000 represents the net taxable profit that I will actually have in future. All right. So on this 20,000, I will have to pay taxes in future. Therefore, the nature is going to be taxable temporary difference. All right. I will have to pay tax on this 20,000 in future. Therefore, the nature is going to be taxable temporary difference. Now, on this taxable temporary difference, I am basically going to recognize a deferred tax liability. I will be recognizing a deferred tax liability of 20,000 multiplied by 30 percentage, which is equal to 6,000. I'm going to recognize a deferred tax liability of 6,000 rupees. All right, because I have to pay taxes in future, I am recording a deferred tax liability of 6,000 rupees. Because this is year one, step number five is going to be irrelevant. Step number five, which basically requires us to calculate the change in DTL, that is going to be the 6,000 rupees itself. All right. So I am going to record a 6,000 rupees amount of liability. So which means I have an expense. All right. I credit deferred tax liability, I credit deferred tax liability, and I debit deferred tax expense. All right. I debit deferred tax expense. Therefore, I'm writing this in brackets. All right, the amount in brackets basically represents the fact that I need to record an expense. All right, so this is regarded as a deferred tax expense of 6,000. All right, so this is going to be the calculation for example number four. All right, but in example number four, there's more further information also given in this section. Let us actually also read that. But before that, let's actually read the solution over here. All right, the entity for the purpose of taxation computes depreciation of 30,000. For the first year, depreciation is 30,000. Therefore, the tax base of this item is rupees 70,000. Why is it 70,000? Because you have an amount of cost of 1 lakh. On that, you actually recorded a depreciation of 30,000 in year one. So in your tax balance sheet, this asset will be appearing at 70,000 rupees. All right, this asset is going to appear in the tax balance sheet at 70,000 rupees. You recorded a depreciation of 30,000 in your tax books, and therefore this asset is appearing at 70,000 rupees in your tax balance sheet. Now let's look at the subsequent paragraph where additional information is actually given. In the above scenario, if entity A decides to revalue the item of plant and machinery, remember, as per Ind AS 16, we are allowed to revalue plant and machinery. We are allowed to either carry plant and machinery at cost, or we are allowed to revalue the plant and machinery and show the plant and machinery at its fair value. All right, so here we are actually deciding to revalue the plant and machinery, and we are measuring the plant and machinery at 1,50,000. Remember, the amount was 90,000 before revaluation. After revaluation, the amount is going to be reflected at 1,50,000. All right, if you think of it, what is the journal entry for revaluation? The journal entry is plant and machinery debit. All right, we are going to increase the plant and machinery by 60,000 rupees. Why am I saying 60,000 rupees? Because the amount was 90,000 in the books of accounts. It was 90,000 in the books. We want to increase it to 1,50,000. We want to increase it to 1,50,000, and therefore the plant and machinery is going to increase by 60,000 rupees. The credit is going to go to revaluation surplus. The credit will actually go to revaluation surplus, which is actually an other comprehensive income item. It is actually another comprehensive income item, and it is not a P&L item. All right, we are not going to take revaluation surplus into P&L, but we are going to actually take it to other comprehensive income. All right, this is the journal entry for revaluation of plant and machinery. Now, obviously, if you think of it, after revaluation, my books of accounts, the plant and machinery is going to actually appear not at 90,000 anymore. It's going to appear at 1,50,000. After revaluation, the plant and machinery on my balance sheet is not going to appear at 90,000. It will be appearing at 1,50,000. All right, we have increased the carrying amount by 60,000 rupees. All right, the fact that we debited the plant and machinery by 60,000 means that we increased the carrying amount by 60,000. All right. So therefore, the carrying value of the item of plant and machinery is now going to be 1,50,000. The carrying amount is going to be 1,50,000. Now I have a question for you. As per tax laws, earlier we purchased the asset at 1 lakh rupees. 30,000 was allowed as a deduction, and remaining deduction that we are going to get in future is 70,000. All right, so we said that the tax base is equal to 70,000. We said that the tax base is 70,000 because this item is being carried on your tax balance sheet at 70,000. In your accounting books, you revalued the plant and machinery and increased its value by 60,000 rupees. You revalued the plant and machinery by 60,000 rupees. Will you also revalue the plant and machinery by 60,000 in your tax books? The question is, will you also revalue the plant and machinery in your tax books by 60,000? The answer is no, because the taxation is not going to allow you a future deduction of any amount more than 70,000. In tax, you cannot actually revalue your plant and machinery and claim a higher amount of depreciation in future. All right, for tax purposes, you cannot claim a higher amount of depreciation in future by revaluing your assets. Under tax laws, you are only allowed to carry your asset using the cost approach. Under Ind AS 16, you have the cost approach or the revaluation approach, whereas under tax laws, you cannot actually revalue your plant and machinery. You are not allowed to actually claim a depreciation on a revaluation amount. You're only allowed to claim depreciation on actual historical cost, which over here is actually going to be 1 lakh itself. All right, 1 lakh out of the 1 lakh, 30,000 has already been allowed as a deduction. So the remaining is going to be 70,000. So your tax base does not change on account of revaluation. In tax books, there cannot be any revaluation. All right, this is the journal entry in accounting books, but in tax books, there is going to be no journal entry for revaluation because tax disregards revaluation. Taxation is not going to allow a higher depreciation for you just because you revalue the asset. Tax is still going to continue to provide you depreciation based on your historical cost. Therefore, the tax base does not actually change. The tax base is not going to change on account of revaluation. The tax base will continue to be 70,000 rupees only at the end of year one. All right, so over here, before revaluation and after revaluation, the carrying amount has changed, but the tax base has actually not undergone a change, which is what the question has mentioned over here. For tax purposes, if the revaluation is ignored, the tax base continues to remain 70,000, which is basically your initial cost of 1 lakh less 30,000, which is equal to 70,000. All right, if revaluation is ignored for tax purposes, your tax base continues to remain the 70,000, which is basically your WDV based on the historical cost. You cannot increase your tax, you cannot increase the value of the asset in your tax books and claim a higher depreciation based on revaluation. Depreciation for tax purposes is purely on the basis of cost alone. Let us actually calculate the deferred tax, although the question obviously did not require you to. Let us calculate the deferred tax after revaluation. Let's calculate the deferred tax after revaluation. We first have carrying amount of the asset. Remember, we are still standing at the end of year one only. We're standing at the end of year one, but now I have revalued the asset. I have revalued the asset at the end of year one. After revaluation, the asset is going to appear in my books of accounts at 1,50,000. It's going to appear at 1,50,000. It was actually originally 90. I increased it by 60,000 to make it appear at 1,50,000. My tax base, as we discussed, it remains unchanged at 70,000. At the end of year one, the tax base remains unchanged at the end of year one. The temporary difference that I have, the temporary difference I have is going to be equal to 80,000. 1,50,000 less 70, which is equal to 80,000 rupees. Now comes the nature of temporary difference. If you start interpreting it, this is basically an asset. The interpretation is this 1,50,000 represents the future economic benefits that I'm going to receive. All right, this basically represents the future taxable income. It represents the future taxable income. The tax base represents the future depreciation that I will be allowed in for tax purposes, the future deductions that I will be allowed for tax purposes. So that is basically 70,000. The net amount of 80,000 represents my net future taxable profit. The 80,000 represents my net future taxable profit. All right. So this is going to be my taxable temporary difference. All right. This is basically going to be a taxable temporary difference. This represents the amount on which I need to pay taxes in future. I need to pay taxes in future, and therefore it's a taxable temporary difference. On this, I am going to basically create a deferred tax liability. On this, I'm going to basically create a deferred tax liability. Step number 4 is I'm creating a deferred tax liability of 24,000, assuming a tax rate of 30%. All right, I have got 80,000 as my taxable temporary difference. I have then created a deferred tax liability because I have to pay tax on 80,000. I have to pay tax on 80,000 in future, and I am basically creating a liability for that today itself, and I am creating a deferred tax liability of 20,000. Step number 5 is basically change in deferred tax liability, which is also going to be 24,000. Remember, this is still year 1 itself. Just that the previous calculation that I did was assuming that revaluation did not actually take place. Now over here, I'm assuming that revaluation has taken place at the end of year 1, and I have actually calculated the deferred tax liability to be equal to 24,000 rupees. Now, what is the journal entry for this? If I ask you the journal entry for this, you would basically tell me that the journal entry will be deferred tax expense debit. Because if I want to create a deferred tax liability, I need to debit deferred tax expense and credit a deferred tax liability, right? And this deferred tax expense, you would say, is a part of P&L. All right, this is basically a balance sheet item, and this is the P&L item. This is the journal entry that you would actually give. All right, but this is actually not the journal entry. This is not going to be the journal entry. Reason being, if you notice, the temporary difference totally is 80,000. I can actually break this temporary difference into two parts. I can break this temporary difference into two parts. All right. I'm breaking this temporary difference down into two parts. The first is difference due to depreciation. Difference due to depreciation is actually equal to rupees 20,000. How do I know that this is actually equal to 20,000? Because when I did the calculation, assuming that there is no revaluation, and I did the calculation, I had a temporary difference of 20,000. All right. And over here, the both in the accounting and in the tax books, I started with a cost of 1 lakh. In accounting, I charged the depreciation of 10,000. In accounting, I charged the depreciation of 10,000, but in tax, I charged the depreciation of 30,000, as a result of which I have a tax temporary difference of 20,000. All right. I have a temporary difference of 20,000, which has arisen as a result of depreciation. All right. So that is a first portion. The first portion is 20,000, which is difference due to depreciation. The second difference is the difference due to revaluation. The second difference is basically due to revaluation, where I am actually going to have the remaining 60,000 of difference. All right, the remaining difference actually has arisen as a result of revaluation. All right, the temporary difference has gone up from 20 to 80,000 because my carrying amount went up by 60,000. When my carrying amount went up by 60,000, my temporary difference also went up by 60,000. All right, so I have actually broken this temporary difference of 80,000 into two parts. The first is difference due to depreciation, and the second is a difference due to revaluation. What the standard says is, because revaluation is an item which is recognized in OCI, revaluation is an item which is recognized in OCI, any tax impact on such item should also be recognized in other comprehensive income. Revaluation is an item which is recognized in other comprehensive income. Therefore, any tax effect on such items should also be recognized in OCI, and the remaining impact which is arising as a result of difference in depreciation, this will be recognized in P&L itself. All right, so tax impact on revaluation should be recognized in OCI, and the remaining tax impact that has arisen due to difference in depreciation should be recognized in P&L. All right, so if I actually split it, all right, earlier what I did is I calculated a DTL of 24,000 directly by applying it on 80,000. Over here, what I'm doing is I'm splitting the 80,000 into two parts. I'm splitting it into 20,000, which has arisen on account of difference in depreciation, and the remaining 60,000, which has arisen on account of difference due to revaluation. The remaining temporary difference has arisen due to revaluation. 30% of 20,000, which is basically 6,000 rupees. 30 percentage of 20,000, which is 20,000 multiplied by 30 percentage, which is 6,000, will be recognized in P&L. All right, this will be recognized in P&L, and 60,000 multiplied by 30 percentage, which is 18,000. 60,000 multiplied by 30 percentage, which is 80,000, will be recognized in OCI. 18,000 will be recognized in OCI. Therefore, my journal entry will actually be deferred tax expense, which is part of P&L, that will be debited by 6,000 rupees. I will have something called as deferred tax expense, which is going to OCI. All right. Now, this part is basically going to other comprehensive income. I am going to debit that by 18,000, and the credit, apologies for these horizontal lines that are coming up. The total will be credited to deferred tax liability of 24,000. All right. So I continue to show deferred tax liability on my balance sheet of 24,000, but the entire 24,000 is not going to be recognized in P&L. I'm going to recognize 6,000 in P&L, and the remaining 18,000 will actually be recognized in other comprehensive income. All right. In other comprehensive income, I will have a revaluation surplus of 60,000. All right. Remember, I showed you the journal entry for the revaluation surplus. I'm basically going to have an income of 60,000 in other comprehensive income, which represents a revaluation surplus. And I will also have a deferred tax expense of 18,000. All right. On that 60,000, I have 30% as deferred tax expense, which is of 18,000. So the net OCI, the net other comprehensive income, will actually be 60,000 less 18,000. The net OCI is going to be equal to 60,000 minus 18,000. It's going to be 60,000 less 18,000, which is equal to 42,000. All right. This will be my net revaluation surplus, and this is going to sit in my accumulated other comprehensive income as revaluation surplus. This is going to sit in my accumulated other comprehensive income on my balance sheet as revaluation surplus. All right. So therefore, what I tried to communicate using example number 4 is that if there is any gain or loss recognized in OCI, the tax impact on such gain or loss should also be recognized in other comprehensive income itself. All right. So if I have a revaluation gain which is recognized in OCI, any deferred tax being calculated as a result of such revaluation gain should also be recognized in other comprehensive income. Over here, I had a gain of 60,000. Therefore, there was a deferred tax expense of 18,000 that I had to recognize. A deferred tax expense of 18,000 is recognized in OCI, and the net other comprehensive income is going to be 42,000, which is 60,000 less 18,000 of 42,000. All right. Any deferred tax on account of difference in depreciation will be recognized in P&L, because depreciation is an item of P&L itself. All right. Depreciation is an item that is recognized in P&L. Therefore, any difference over here will be recognized in P&L, but any difference which is arising on account of an item recognized in OCI will actually be recognized in other comprehensive income. That is what we actually learned via example number 4. The institute example did not require us to go into such details. It obviously, there is a reference of what we have just discussed is referenced much later in the chapter, but because this example had such a scenario, I thought we could actually cover it here. With that, we're done with example number 4 as well.